Well, the Prescient Equity Active Quant Fund has returned just over 11% per annum since inception, which was in December 2006. The fund's benchmark is the JSE Africa Shareholder Weighted Index, which returned just over 10% over the same period. For more, we're joined from Cape Town by the group's head of equities, Adriaan van Niekerk. Adriaan, thanks very much for your time. Well, Adriaan, before we jump into the semantics around your fund, if you could give me a high-level view of the equity environment in South Africa right now and whether you deem there to be equity in that environment.
Thank you, Bronwyn. I think if you look at where interest rates are at this moment and valuations, I think there is still some value in our market. It certainly seems as if we're breaking a range at this stage.
Hi, Adriaan, Warren here from Investors Monthly. Just to ask you, for the benefit of the audience and I guess the investors in your fund, could you just explain the quantitative model in very broad terms? Specifically talking to the different factors that you employ in your model, and specifically what the interaction and momentum factors mean when you put your model together.
Sure, Warren. First of all, we also believe in value, but we recognize that value isn't the only driver of returns in the market. You can wait for a long time before value realizes. Therefore, we have two extra factors, like you noticed, the interaction and momentum factor. And currently, we see the momentum factor really working well, as well as the interaction factor. Now, the momentum factor is purely based on price momentum, so it's really sentiment driven, while the interaction factor is really a combination of the two. So that factor avoids selecting shares that are cheap for a reason, and it also avoids selecting momentum shares that are very expensive. So the combination of those three factors really enable us to give a very stable performance profile.
Your resource exposure right now is what you deem to be the value factor, and it's one of the reasons you've cited for perhaps underperformance against your benchmark of late. When do you expect that to turn around?
Yes, certainly the value factor has detracted from performance, and that is because resources really just continue to underperform and become more and more valuable. When we see the resources sector to turn around and we see sector mean reversion, we will see the factor to outperform again. That doesn't necessarily mean that the other two factors will underperform, and you can have a situation where all three outperform, and you'll see healthy outperformance then.
Okay, so Adriaan, just on that, are the factors equally weighted? So is it split a third between the different factors, or is there one that's more predominant than the other? And do those weightings change during the course of a market cycle?
We do run a risk-return model, so we look at our risk, and our risk is the underperformance of the benchmark. And then we get to an optimal point where we weight the interaction, the momentum, and the value factor, where we believe there's the least risk of underperformance. So at this stage, we are 45% in the interaction factor, 35% in the value factor, and the remainder in the momentum factor.
Okay, so just in terms of the actual way that this works is that I presume your model begins with the scanning a universe of stocks on the JSE, which I would imagine revolves around the Swix index, as you pointed out, is the benchmark. How often do you rebalance the portfolio once you've taken the stocks through these different metrics?
We do look at, first of all, we look at the liquid stocks only. So that's around about 75 to 85 stocks, depending on what the turnover of the shares are. And then what we do is we rebalance on a monthly basis. The three factors on their own, we won't really change the weighting towards the three factors on a monthly basis. It depends on what the risk return statistics tell us. But on a monthly basis, we do look at the financial statement metrics. we look at the momentum of the shares and also in the interaction factor, and we will rebalance the individual stocks in each one of those factors.
What churn does that rebalancing in effect create? So let's take, for example, MTN being 8.46% of the fund. Given the rebalancing on a monthly basis, could we assume that for the last 6 months, MTN had been at the top of the pile, or have you seen flux in that position?
Bronwyn, we certainly bought some MTN at the lower point when the negative sentiment in MTN started to abate, and there was always value in MTN. And when the sentiment started to be more positive, it came into the interaction factor, and we are in fact now overweight relative to the SWIX. You will notice that MTN is also the largest weight in the SWIX, so that's one of the main reasons why it has such a high weight in the portfolio.
Okay, Adrian, is it plausible for a company to be very highly very highly measured according to all three metrics? Because I see you have Sasol there. I know momentum is something that happens in the short term. And that share would react to the price of oil in the short term, but many people think it could be a value play at the moment. Do you have many stocks that fit all three categories?
Yes, to come back to Sasol, that's only purely because of value. We don't see it coming into the momentum or interaction factor at this stage. But if you look at our top overweights, the likes of Imperial, First Rand, those three are all in all three factors, and hence they have the highest overweight. I think Mondi is another one that offers value. It's got good sentiment behind it in the momentum factor, and it's also in the interaction factor.
Okay, so just to clarify then, the models that you guys build at Prescient, you take no account of what other fund managers call the qualitative aspects, i.e. The quality of the management, the strategy, a new product that wouldn't feature in your analysis because you're strictly quantitatively focused at this point.
Yes, we are strictly quantitatively focused. It doesn't mean that we won't build in a qualitative factor, but that won't be based on forecasts at all. We purely take what's priced in the market, what the prices are doing, and what the financial statements are telling us at present. So we don't look at any subjective forecast, we look at what's priced in at the moment.
In terms of Anglo-American, now you would assume with the value bias that you are assuming with regard to resources, that Anglo-American would probably meet a number of your criteria. Why its omission? What is exactly missing from the Anglo-American story?
Well, if you look at our momentum factor, it still doesn't come in there. I think Billiton is one that's actually performing better. That tells us that the market prefers Billiton to Anglo's. And the market was quite right. If you look at what happened to Anglo's earnings release, that was quite a significant drop in their yearly earnings. So the momentum factor certainly has a forward-looking mechanism built into it. So Billiton is in fact overweight, but Anglo's, the sentiment is still not there. So we will wait for the sentiment to return to Anglo's before we have a higher weight in it.
Just to ask you a question, Adrian, when you run these models and you make these adjustments every month, in markets as volatile as we've seen lately, are there a lot of companies moving between the three different legs, the three different factors of your model? Is it almost like juggling balls at the moment? They seem to be in perpetual state of motion between the different factors, or have things calmed down and you generally find that from month to month the same stocks that were in factors, the value factor, are still in the value factor, and vice versa for the momentum and interaction factors?
You're quite right there, Warren. We've seen quite a bit of volatility in the sectors relative to each other. So Billiton come into interaction and it went out again. Then we've seen a couple of stocks, individual smaller stocks that's been overweight but have disappointed on the earnings side, like Barloworld is a good example where it missed estimates. and then the sentiment was all negative, and the quantitative model told us to sell. So there have been quite a few changes over the past couple of months, and I would say sector volatility. But that's always going to be the nature of such a model, and you have to adapt as the market adapts.